The following is a sponsored program paid for by First Alliance Credit Union. Welcome to Good Money Moves, featuring Jenna Taubel from First Alliance Credit Union and Andy Brownell. Here's Andy Brownell on Rochester's News Talk, 1340 KROC AM and 96.9 FM.
It's time for Good Money Moves. I'm Andy Brownell with News Talk 1340 KROC AM and 96.9 FM. I'm joined, of course, by Jenna Taubel, AVP of Marketing with First Alliance Credit Union. Hi, Jenna.
Hey, Andy.
So last week, we talked through the differences between home equity loans and home equity lines of credit. What's the topic this week on Good Money Moves?
Yeah, so we've talked a ton about HELOCs and home equity a few times in the past couple episodes, but I thought it might be good to take some time to dig into a more specific use for home equity that we haven't really covered or even talked about yet, but can be a common question that people have, and that is, can you use a HELOC to pay for a second home or even an investment property? And how do you do it? So, yeah, using a HELOC can really help homeowners leverage a larger down payment on something like an investment property or a second home with access to lower interest rates, which really can lead to some significant long-term savings, but there is a lot to consider when it comes to making this choice. So that is what we were going to dig into today.
A big, giant however in there.
Yeah.
I know people who have done this.
Yeah.
And they have done it very successfully and have used it to grow their wealth quite significantly.
Yeah. Yeah, it's common.
Okay. I guess where to start? I bet this one that there's a lot to cover. So I guess before we dig too deep, maybe we should go back a little bit for those who didn't tune in to those episodes you just referenced. Maybe do a quick refresher on HELOCs and how they work.
Yeah, great idea. So a HELOC, also known as a home equity line of credit, is a loan that lets you borrow money against the equity you've built up in your home. So you can kind of think of it like a credit card, but instead of your credit limit being based on your income or your credit score, it's based on how much of your home you owe outright. So you're using the amount of your home that you owe versus own to get a loan. Your home serves as the collateral.
Yep.
So you get this set credit limit based on that equity. And then during what's called the draw period, which is usually about 5, 7, 10 years, you borrow, again, repay as needed over that time frame. After that draw period ends, the repayment period begins, which can last up to another 10, sometimes 20 years, where you pay back what you owe plus interest.
So essentially, at the end of the draw period, it more or less converts into a home equity loan with, I guess it wouldn't be fixed payments because the interest rate's not fixed necessarily.
Correct.
Okay.
Yes. I mean, the payments become more fixed because you're not constantly varying that balance anymore.
Sure.
But yes, and typically, we kind of talked about this off air last episode, but typically most people are having the majority of that paid down before that repayment period begins.
Yep.
That's the advantageous way to handle that. But just for an example, let's say your home, to kind of make sure everybody understands what we mean when we say equity. Let's say your home is worth market value $200,000. You owe on your mortgage $120,000. That gives you about $80,000 in equity that you can access through a home equity line of credit.
But I can't get all of it.
Not always. So it depends on a lot of factors, but typically lenders let you borrow up to a certain percentage of that equity. So 85 is, let's just use that as a number. So they'd let you borrow up to 85% of your equity of that 80,000 that would get you about $68,000 in access to that credit, in a credit limit through a home equity line of credit.
Okay.
$68,000. That's not a small chunk of change.
Oh, goodness. No, it's not. So we have the $68,000 on your hypothetical.
Mm-hmm.
And the topic this week is using that money as a down payment towards the purchase of another piece of real estate.
Mm-hmm.
What's the benefit of doing it this way?
Yeah, so using a HELOC to buy a second home can be a really smart strategy. So you can use the funds as a down payment for a home you plan to live in, or even to help purchase a property outright in some cases. Depends on how much equity you have and how much the house costs. It's particularly useful if you're buying into investment properties, or, possibly a cabin on the lake as a second, like a vacation home, right? It's a common thing people do, but we haven't talked about it a lot on this show.
No, we haven't.
So one of the primary advantages of using home equity to buy like an investment property specifically is that it can make the purchase significantly more affordable. So often when buying a second property as intended for an investment property, buyers typically need to take out a loan for funding. Most people don't have that kind of cash just sitting around to buy a second home that they don't plan to live in. So home equity loans and home equity lines of credit tend to have those lower interest rates than a traditional mortgage loan, which can help reduce those monthly payments and overall costs over time as you're trying to buy in and kind of make this property, turn it into something that's going to make you money. So also, something to be mindful of is lenders typically require larger down payments on a second property than they would on your first property.
Sure.
Meaning
you're going to need,
it's a higher risk, meaning you will need to secure typically, and it's going to vary lender to lender, situation to situation, secure a minimum of 20 to 30% down in order to finance that purchase. So if you think about 20% is kind of the rule of thumb for your first mortgage down payment, but most people don't have that. Most people probably put about 5 to 10% down. So that's not necessarily something you're going to get away with on a second property in a lot of cases.
You're not going to get that mortgage insurance.
Right.
Like you do on a home that can make up for the difference.
Yeah, it is viewed differently. So another benefit of using home equity for financing, an investment property purchase is that it allows buyers to access those larger amounts of liquidity than if they were relying solely on savings or other forms of financing. So with that more money available up front, buyers are able to use these funds for necessary repairs or renovations before turning around and renting out that property on this new home, or, as they kind of step into this investment real estate rental property. It's also typically helps eliminate some of the red tape associated with closing costs, because closing costs on a home equity line of credit are lower than what you would pay on like a traditional mortgage. And in some cases, depending on the lender, sometimes they even offer like really low or no fee closing cost options to kind of entice people to come use them. So you can always look out for things like that too. Those do happen. I would say, the major advantage of using a home equity loan to buy a second home is that it may not, may be or only your only significant source of funding if you find yourself house rich but cash poor, right?
Which is common for a lot of folks.
It's super common, right? So it's an excellent source of funding that there's no other way to tap into that level of resource. So again, just kind of another potential plus is that the interest rates on those home equity loans are typically lower rates than other forms of borrowing, but they are typically a little bit higher interest rates than, say, on a regular mortgage loan.
Yeah, but if you were to go out and apply for it becomes a commercial loan essentially, right? If you're buying it as an investment property,
Mm-hmm.
and those
Mm-hmm.
do definitely carry a higher interest rate.
Yeah. Again, lots of factors to think about here, but you can use it.
I like the cabin option. That seems like really, really attractive option.
Mm-hmm.
Now that
I'd love a cabin on a lake. Yeah.
All right. We're talking about using that HELOC to perhaps purchase investment properties, vacation properties, another home, perhaps. Right here on Good Money Moves, looking into the positives and potentially the negatives. We'll be back in a moment with Jenna Taubel, First Alliance Credit Union, on Newstalk 1340 KROC AM and 96.9 FM.
Good Money Moves continues in moments with Andy Brownell and Jenna Taubel from First Alliance Credit Union. This is News Talk 1340 KROC AM and 96.9 FM. We're talking Good Money Moves with Andy Brownell and Jenna Taubel from First Alliance Credit Union on Rochester's News Talk 1340 KROC AM and 96.9 FM.
We are back with Good Money Moves. I'm Andy Brownell. Jenna Taubel is here with First Alliance Credit Union. And we're talking about tapping into that home equity with an HELOC to purchase another piece of real estate. So, as I hinted going into the break, I imagine there are some risks involved in using that home equity as a down payment.
Yes, absolutely. There are definitely risks to consider. I would say, in short, getting a HELOC is one of the quickest ways to turn an asset into debt, which is always a risky move. So it's really important to consider whether taking on an additional loan and increasing your total debt load really makes sense for your situation. And if it's not managed carefully, those higher debt levels can have some really serious implications for your finances and even potentially lead to something like foreclosure or bankruptcy down the road. Again, we're, worst case scenarios here, but it's a possibility and it is a risk to consider. So additionally, some lenders have restrictions regarding the source of your down payment, and they may not be willing to issue you a mortgage for the remainder of that home if you're using home equity loan for the purpose of a down payment. So make sure you're clear and upfront about that. Yeah. Yep. There's interesting rules about down payments. That could be a whole nother episode. I think the biggest downside of using a home equity loan for, buying another property or really for any other purpose, mind you, is that you're putting your primary residence at risk because that is what is serving as the collateral for that loan to secure it. So if you find yourself unable to make payments on your home equity loan, the lender could, again, foreclose on your home, evict you. Not a situation you want to be in. That's where it's like, not that it's likely, right? If you manage it well, you know what you're getting into, you have a plan for how you're going to repay it, but life happens. So you just can't predict everything. Also, owning two properties in the same housing market can kind of leave you a little bit more vulnerable to shifts in that real estate market, meaning, right, so because all homeowners have a level of potential risk when it comes to these types of changes, naturally, you're now doubling that risk because now you own two homes and it opens up that higher degree of potential for that loss if the market declines. And, right, you can become underwater on your mortgage, and now you've just increased that possibility twice. So most importantly, though, like any decrease in value for either property, again, it just leads to more debt being owed on your mortgage and the home equity line of credit. It creates a situation which may become impossible for one person to manage financially if things don't go well. So be mindful. Like these are things you do want to think about, and they're not common necessarily likely in every scenario for every person, but you do want to be thinking about what you're exposing yourself to from a risk standpoint and be mindful of it.
Laying awake at night, in other words. I'm kidding, but you were all happy, let's go get a cabin, and now I'm back to going, okay, maybe not. But like I said at the beginning of the program, I've noticed some people who've done this, and they have used it as a way to get into the investment property financial growth model, and it has worked out really, really, really well for them, especially in a market like we have here in southeastern Minnesota, where we're somewhat insulated from some of the downturns because of Mayo Clinic. But I'm sure that doesn't erase all risk either. That's for sure. So what other options are out there for funding a down payment if I want that second property?
Yeah. Some alternative funding options you can think about if you are looking for a down payment on a second home or even possibly an investment property include cash savings from like friends, family, personal loans. I'm going to use that term that we used last week, cash out refinancing again. So cash is obviously the best option because it avoids building debt, but is not always the easiest to access, right? Especially when lenders are going to be requiring a pretty sizable down payment. It's not always something most people have access to. If you do, great. But just know it's not likely that you're going to be able to come up with, a 30% or more down payment for a second property. Again, going back to that cash out refinance is another option. So with a cash out refi mortgage, you receive a new primary mortgage on your home. The new loan will include your remaining mortgage balance as well as the portion of the equity that you've built up over the years, which then you get that back in cash, which you can use immediately for really any purpose, including potentially a down payment on another home. So personal loans can be used to fund down payments on a second property. With a personal loan, you can, in a lot of cases, you can borrow a significant amount, $50,000. Some lenders will even offer up to $100,000 in certain situations for certain applicants. So it is an option to consider. However, personal loans do tend to have higher interest rates than home equity products. Also, most lenders won't let you use an unsecured personal loan on mortgage finance purchases.
Oh, there we go again.
So, yeah, there's ways to do it, but it's not necessarily, let's say, I wouldn't recommend this being your first avenue. If you can do, a cash deal, though, like a personal loan could actually help you get over that finish line. So if you have, half of what you need and you just need the other half,
gotcha.
You could look at a personal loan, but I don't know, you still might be better off just getting a straight mortgage in that case. Again, it's always nuanced for each situation what makes the most sense. And you, at the end of the day, there are ways to use a personal loan for that.
Yeah. Well, I can imagine if you had enough cash and you're almost there, that you needed just a reasonable amount. And then you wouldn't have a mortgage.
Yeah.
You would just have the personal loan. Despite the higher interest rates, that might work.
Yeah.
So this is one of these deals you really, really need to do your homework. Serious homework.
Yeah. Crunch your numbers. Be very mindful of what you're doing.
That's something you should do all the time. But
yes.
Okay. We're talking about using a HELOC, using your home equity to get into a second piece of real estate property. And we'll be back in a moment with more of Good Money Moves. I'm Andy Brownell with Jenna Taubel. It's News Talk 1340 KROC AM and 96.9 FM.
Good Money Moves continues in moments with Andy Brownell and Jenna Taubel from First Alliance Credit Union. This is News Talk 1340 KROC AM and 96.9 FM. We're talking Good Money Moves with Andy Brownell and Jenna Taubel from First Alliance Credit Union on Rochester's News Talk 1340 KROC AM and 96.9 FM.
Good Money Moves. I'm Andy Brownell. Jenna Taubel's here with First Alliance Credit Union, of course, talking about tapping into home equity, using a HELOC or other methods to buy real estate, second homes, cabins, business properties, whatever it may be. and we've covered a lot of ground already. So, maybe we should go back and kind of do a recap, right? Cover the pros and the cons.
Yeah, it's a lot to think about, and we kind of went through it fast. So I'll kind of break it down, between pros and cons. So pros of using your home equity to finance a down payment on a second property, whether it's an investment property or a cabin on the lake. First, you won't have to touch your savings. So by taking out a home equity loan or a HELOC, you can get the cash that you need to buy another home without depleting your bank account or another investment account. Two, you can keep your current home and mortgage, right? You don't need to sell or rent out your house to get the funds for another home purchase. And you can leave your, especially right now, if you have a low rate mortgage, I wouldn't recommend a cash out refi right now. You're going to probably double your interest rate. So you can kind of leave that untouched. So you will also be a more competitive buyer. So with funds from your home equity loan, you can make a larger down payment on a new home than you could if you had just saved up cash for it. Or in some cases, depending on how much equity you have and how much of the cost of the property you're looking at is, you might even be able to buy it outright. You can also potentially lower your borrowing costs, right? Home equity loans, HELOCs, they're secured by your property, and as a result, they tend to have lower interest rates than something like a personal loan, which is an unsecured loan. And lastly, as far as pros for using your home's equity as a down payment on a property, is you have a little bit longer time to repay. So home equity loans and lines of credit generally have longer repayment periods than, like, say, a personal loan would. So that leads us to the downsides of using your home equity, which the but cons of using your home equity for a second home purchase or a down payment on an investment property. You could lose your home. It's your primary residence serves as the collateral for that home equity loan or the line of credit, and you do have to repay it. And if you can't, your lender could take your house. That's the reality of any type of borrowing. Second, you're trading in your hard-earned equity for more debt. So again, you're turning what is an asset into debt. And in addition to your second mortgage, you'll now also be responsible for a home equity line of credit payment, as well as that mortgage on your new property. So it can be a lot to deal with. I mean, you could potentially be looking at 3 loans: your first mortgage, your HELOC, and any mortgage you have to take out for your new property if you do need to do that. So
unless you already own the home outright and you have 100% equity.
Correct. Which is also a real possibility for our listeners. You could be in that situation.
I think the latest stats I read on that nationwide, it's like 35%.
Yeah. Yep. And another downside.
Okay.
To be a Debbie Downer, you might end up underwater, right? If you give up a big chunk of your equity and property values decline, you could end up owing more on your home than it's actually worth, especially if you've got multiple home secured loans. And as a result, you'd go into negative equity, otherwise known as being underwater on your mortgage, which has happened to many people in recent history. So Be mindful. You're also on the hook for closing costs, just like a primary mortgage, home equity lines of credit, home equity loans, they come with closing costs. Thankfully, on average, those costs range from like 2 to 5% of your total loan amount. Sometimes they're closer to 1%, so not nearly as high as a primary or a traditional mortgage, but they still do exist. Something to be mindful of. And you might, in some cases, pay more interest. I mean, it's certainly cheaper than unsecured debt, but those kind of second mortgages, home equities, they carry higher interest rates than primary mortgages or even refinancing in some cases. So those are also some things to just be thinking about as you're considering how you might get a down payment to make that second home or investment property purchase.
Definitely things you have to factor into the equation. And I have a feeling that, once again, we've only scraped the surface.
Oh, yes.
on this topic. This is the kind of decision, a big decision. You really,
You're going to have to listen to more than just this podcast to make
you
that
probably
decision.
should tap into somebody who's done it before or has some really deep knowledge of it before you do it.
Yes.
Okay. So where can we go to tap reference materials, I guess, maybe to read some more about HELOCs or home equity loans or anything else, let's say, about things that can help us make good money moves, financial literacy. How can we do that? Where can we find it?
Yes, as always, I encourage our listeners to visit our website, firstalliancecu.com. You can subscribe to our blog. We release new financial tips and advice every week. You can listen to past episodes of this show at firstalliancecu.com/podcast or on krocnews.com. You can also subscribe to Good Money Moves on Apple Podcasts, YouTube Music, and Spotify. And as always, I encourage you to reach out to our team at First Alliance Credit Union. We are here to help you start making good money moves today.
That's First Alliance Credit Union, federally insured by NCUA, and an equal housing lender. Thanks for tuning in to Good Money Moves. I'm Andy Brownell, Jenna Taubel, of course, with First Alliance Credit Union. Thank you so much.
Of course.
And we'll get together again next week and cover another topic on Good Money Moves here at News Talk 1340, KROC AM and 96.9 FM.